Hi. Chapter 6 covers Schedule C, which is used to detail self-employed business income and expenses. Learning objective number 1 gives us definitions. Gross receipts includes things like direct sales to customers, work performed for other businesses as an independent contractor, and W-2 and 1099 NEC contractor income. Learning objective number 2 gives us a couple of definitions. Ordinary and necessary expenses. Ordinary must be customary or usual in the taxpayer's business, per the Supreme Court. And necessary refers to an expense that's appropriate and helpful as opposed to one that's essential. Courts have ruled that an expense must not only be ordinary and necessary, but there's one more requirement. It must be reasonable in amount. There are several expressly forbidden, non-deductible expenses. Illegal bribes, kickbacks, and other payments. Payments for certain lobbying and political expenses. And payments for fines or penalties. Now we're going to take up learning objective number 3, depreciation. There are 4 components of depreciation: basis, which is typically the cost of the asset; depreciation periods, and in this case, it's maker's asset class lives that the government provides; depreciation convention, half year, mid-quarter, mid-month; and finally, depreciation method, 200% or 150% declining balance, which switches to straight line when the straight line depreciation is more than the 200% or 150%. So basis, the cost of the asset. Personal to business, in other words, you take personal property and contribute it or put it into service for the business. The basis is going to be the lesser of the fair market value at the time it's put into service or the original cost, whichever is less. Non-taxable exchange, it's going to be the cost less any deferred gain if there is any. And finally, with inherited property, typically inherited property will come in. The basis will be whatever the fair market value was at the time of death of the person who owned it. So let's take a look. Depreciation concept check 6-3. Shelley purchased a laptop computer for her personal use last year for $2,200. This year she started her own business and transferred the computer to business use. The value of the computer at transfer was $1,300. What is her depreciable basis? Well, remember we said it's going to be the lower of the cost or the current market value. The market value is $1,300. That's what we use. Jackson purchased a van for $22,000 and used it 100% for business. In the current year, he deducted $4,400 in depreciation related to the van. What is Jackson's adjusted basis in the van at the end of the current year? Well, it's going to be what he paid, the $22,000, minus the depreciation that was taken, $4,400. Typical depreciation periods. Now, these are schedules, maker's schedules of depreciation. 3 years for tools, racehorses. 5 years, autos, trucks, computers. 7 years for furniture and fixtures. 27.5 years for residential real property. 39 years for non-residential real property. So concept check 6-4. An auto used in a trade or business would be depreciated over what period of time for makers? Well, autos, we said 5 years. So the answer would be B. An apartment complex would be depreciated over what period of time for makers? Would be C, 27.5 years. A warehouse would be depreciated over what period of time for makers? That would be 39. Now, depreciation conventions. The half-year convention, mid-quarter, and mid-month. The half-year convention says that whenever you put an asset into service in a year, you take half a year as your depreciation. And that's built into the schedules. The reason being, if you look at the schedules, a 7-year schedule has 8 percentages. A 5-year schedule has 6 percentages because you're getting a half year at the beginning and a half year at the end. The mid-quarter convention treats all property placed in service during any quarter of a taxable year as placed in service at the midpoint of the quarter. Taxpayers must use mid-quarter convention when more than 40% of the personal property is placed in service during the last 3 months. The mid-month convention says all property placed in service during any month is placed in service on the midpoint of the month. The mid-month convention is only, though, for real property. A taxpayer can choose any depreciation convention as long as he or she is consistent in doing so. False. False. You have to use the maker's schedule that's appropriate for that asset. A taxpayer must use mid-quarter convention for personal property if more than 40% of the property is purchased in the fourth quarter. True. That 40%, that's the key there. 3, the half-year convention is the most often used convention for personal property. Yes, of course, it's built into those schedules. To depreciate an apartment complex, a taxpayer should use the half-year convention. False. And finally, the taxpayer must use the same depreciation convention in the year of disposal as the convention used in the year of acquisition, and that is true. There are basically 3 depreciation methods: 200% declining balance, 100% declining balance, and straight line. However, 200% and 150 will change to straight line when the straight line depreciation is higher than the declining balance depreciation. Shu purchased a piece of business equipment for $12,000 on May 3rd, 2020. This equipment is the only business asset Shu purchased during the year. What is her depreciation expense? It would be $1,715. If Shu sold the equipment on January 5th, what would the depreciation expense be for 2022? $1,049, half-year convention. Now, Section 179 allows to take a certain amount of expense deduction as opposed to depreciation. The maximum for 2019 was $1,020,000. The maximum for 2020 was $1,040,000. Section 179 expense cannot create a loss. NOL, net operating loss. Assume the same asset purchase as Concept Check 66. Purchased a piece of equipment for $12,000 on May 3rd. This equipment is the only business asset purchased during the year. And the business has substantial income, so we don't have that loss issue. What is Shu's deduction for the equipment, assuming 179 expense is elected? It would be the full $12,000, and there would be no additional makers. Under number 2, if the equipment was $1,045,000, what would be the total expense deduction at 179? The expense deduction would be the maximum of $1,040,000, and the difference between $1,045,000 and $1,040,000 would be the additional makers, in this case, $715. There's also something called listed property. Listed property are assets that have both a business and personal use component. So the taxpayer needs to determine how much is personal and how much is business. Section 179 is not allowed if the listed property used less than 50% for business. Straight line depreciation is required for listed property used less than 50%. Luxury automobile limitations as far as depreciation. First year, 18.1. Second year, 16.1. So these are limits of depreciation, no matter what you paid, what was paid for the vehicle. SUVs greater than 6,000 pounds. Section 179 is limited to 25.9. Zachary purchased a Ford Expedition weight more than 6,000 pounds for $39,000 in March 2020. What is the maximum depreciation expense allowed, assuming Zachary is eligible for the 179 expense election? 28,520. Transportation and travel, and there is a difference in definitions. There must be ordinary and necessary travel expenses deductible. Transportation is expenses of getting from one workplace to another workplace within the taxpayer's home area. Travel refers to business travel away from home and requires an overnight stay. So we're talking about meals and travel as well. Deductible local transportation cost, getting from one workplace to another, visiting clients and customers, going to a business meeting away from the taxpayer's regular workplace, and then getting home, obviously, getting from home to a temporary workplace when there are more than one regular workplaces. The standard mileage rate for 2020 was 57.5 cents a mile, or the taxpayer can use actual expenses, so actual business auto costs can be deducted. Go either way. However, understand that if you use actual expenses, there has to be a log showing mileage and payment and receipts for the expenses. Travel cost for business travel requires an overnight stay. It includes travel, meals, lodging, and other incidental expenses. It should not last more than 1 year. And there are limitations if there's personal visiting as well as work. Business meal costs are deductible, but limited to 50%. Must be directly related or associated with business. Business entertainment is no longer deductible. Standard meal per diem is $55 a day. And again, reasonable. Use of the home is deductible if the business use is exclusive, regular, and for the taxpayer's trade or business. And it has to be in a specific area of the home. Employees' use must be for the convenience of the employer. Home office deductions are on Form 8829. Calculation is determined by square footage used in relation to the entire square footage of the house. Direct business expenses are 100% deductible. Everything else, square footage. Expenses deductible in any event, mortgage interest, real estate taxes. Jose uses 20% of his house exclusively for business. He had the entire exterior of the house painted and the interior of one room that he uses for an office painted for $3,000 and $5,000 respectively. What is the total deduction Jose can take as a home office expense? $1,100. Which of the following comments is true? The home office deduction is limited to income from the Schedule C business. When a business property is partially destroyed by casualty, the loss is calculated using which of the following? The decrease in the fair market value, the adjusted basis, the lower of the decrease in fair market value, or the adjusted basis of the property less 10% of AGI. The answer is C.